Qualcomm won a legal court case against ARM late last week, and so you may be wondering, is it a good time to buy Qualcomm now? In this video, we will analyze unusual option activity from today, December 23rd, to show how wealthy investors are trading Qualcomm today. So without further ado, let's dive into the data as usual. As we can see here on the options time and sales tape, this morning we had a lot of these February 21st options trades happening at the 165 strike calls and the 185 strike calls. Now note, these trades were being done as a spread, and you can see that these were being done at the same time. You can see here at 9:37 at the 17-second mark, we had another trade here. And so these are paired together. And we have this 165 over here at the 28-second mark paired with this trade. And this 31-second mark was paired with this trade. And so that is why these trades are the most meaningful. And that is why we are analyzing it to find out what this wealthy investor is doing. So let's take a deeper look at the option chain to find out more about these unusual options that expire February 21st. So we can see here at the 165 strike calls, we have a total volume of 4,000 trades happening. This is clearly an opening trade and not a closing trade because the open interest is much less at 2,059. And also at the 185 strike calls, we have the 4,000 being traded and only 569 open interests. So we know both of these options are opening trades. And based on our analysis, they were buying the 165 strike calls to open and selling the 185 strike calls to open. And you can see that we are also in the same position. Green means buy, red means sell. And so you can see that this is their trade here. When we analyze it on the risk profile, you can see here that as the share price goes up, which is currently right here, this trade becomes more positive, profitable. And if it goes down, you can see it becomes more negative loss because this is a long bullish trade. And we can confirm it on the Greeks here. We have a positive delta trade. If it was a bearish short trade, it would be a negative delta. And we can also calculate the approximate trade cost because we know that this investor here spent about $715 for these 165 strike calls, and for the 185 strike calls, they sold for about 193. And so if we calculate the 715 subtracted by the 193, we get $522 per trade. And we know there was about 4,000 contracts or trades, so we multiply that out, and we get a total trade that costs about $2 million. But keep in mind, just because this is a $2 million trade, it is still not a higher probability of profit trade in comparison to the trades that we share on our website, because news was reported about Qualcomm very recently that was very favorable. And so this lowers our probability of profit, and that is why it is a higher risk trade in comparison to the trades that we share on our website. If you are interested in the higher probability of profit trades where there are no news releases, so that there is a higher chance it is an insider trade based on information that has not been released publicly in the media, so that we can trade it before the stock rallies, then make sure to go to our website. We'll put a link over here where you can gain access to better trade ideas that have a higher potential of profit in comparison to this one over here. Let us know in the comments below. Do you think Qualcomm is now a good buy after this winning court case against ARM? And as usual, please smash the like button, subscribe if you haven't, take care, and have a wonderful day.